Let us try solving the following exercises for a merchandising concern. You will give me the journal entries for the following transactions. Maria invested 2 million to ABC Corporation. So that means the owner invested a merchandise inventory. So the debit should be, because this is the beginning was this capital infusion by the owner, so the debit should be merchandise inventory, debit, 2 million, credit, Maria, capital, 2 million. So, on the same date, January 1, Maria invested again 1 million in cash to ABC Corporation. So, the debit will be an increase in cash, which is an asset form. So, the debit should be cash, 1 million. Since this is an additional to your capital account, so you credit Maria, capital, because this is an addition to the capital account of Maria. So, Maria capital credit 1 million. On January 2, purchased merchandise 500 on account to Leo. So, when you say you purchase a merchandise, you purchase merchandise intended for selling, for resale, because you have a merchandising business. So, when you purchase merchandise for resale, you debit purchases. So, debit purchases 500,000, and because you purchase it on account, meaning you did not disburse cash because it is on account, therefore you incurred liability. So, you credit accounts payable to Leo 500,000. On January 3, sales on account 100,000 to Nida. So, you incurred, no, you not incurred, you had sales on account. When you say on account, meaning you did not receive cash. That means you sold to somebody who will be paying you on a later date. So, debit accounts receivable, which is an asset account, and receivable, because you haven't received cash yet. So, debit accounts receivable, Nida, 100,000, and credit sales. Sales has a normal credit balance because you have to recognize the sales on this date. So, accounts receivable, Nida, 100,000, credit sales, 100,000. January 4, purchase return of 100,000 from Leo. So, when you purchased from Leo, you found out that there are damages to the merchandise, so you need to return some items. So, you debit accounts payable, Leo, 100,000. Why debit accounts payable? Because on January 2, you purchased from Leo, and on January 4, you discovered that there were damage to the inventory. So, you reduce your payable. To reduce your payable, you debit the liability account. So, debit accounts payable, Leo, 100,000. And you credit purchase returns and allowances. Why credit purchase returns and allowances? Because that is the contra account for your purchases. You do purchase for the debit. To do the contra, you do the credit. So, purchase returns and allowances, credit of 100,000. Next entry, January 5. Sales returns of 10,000 from Nida. Sales returns meaning you recognize sales, however, the buyer returned some items. Maybe there were also some damages from your items that you sold. So, you debit sales returns and allowances because that is the contra account for your sales. Since the normal balance for your sales is credit, the contra account should be debited. So, that's correct. You debit sales returns of 10,000 because you reduced your sales. Okay? And then, you also reduce your accounts receivable. Why did you credit accounts receivable, Nida, 10,000? Because you recognize an accounts receivable from Nida. However, because you need to reduce the account from the returns of Nida, you also need to reduce the accounts receivable by 10,000. To reduce the accounts receivable, what do? We do the opposite, and that is the credit side. So, credit accounts receivable 10,000. Withdrawal of owner in cash. So the owner withdrew some cash, so you debit. To reduce the capital by the withdrawal of the owner, you use a separate account which we call withdrawal by the owner, drawing account by the amount of 5,000, and you credit cash because you have to reduce your cash by 5,000. January 7, Maria invested additional. So he put in additional merchandise, 20,000. So this time, you do not anymore use the merchandise inventory. You use the account purchases. So purchases, 20,000 debit, and you credit, you recognize the capital infused by the owner. So you credit Maria capital, 20,000. On January 8, you paid freight on merchandise sold, 5,000. What do you mean by freight? Maybe this is the delivery expense or the transportation expense, the cost in transporting the goods. So it is a sale. When you recognized a sale and then there was a delivery expense, you use the account debit freight out 5,000 and you credit cash 5,000. Purchase, why is it debited? Because freight cost is part of your purchases. And then January 9, you paid freight on merchandise bought. So this time you are the one buying the merchandise. When you buy the merchandise, you recognize another cost, but this time we call it freight in. Why freight in? Because it is part of the cost when you bought the merchandise. So debit freight in 2,000 and you credit cash 2,000 because you have to reduce your cash. January 10, withdrawal of merchandise by the owner. So this time, the owner reduced the merchandise that he deposited or he invested in the company. So debit Maria, drawing 3,000 and you credit purchases. Why did you debit drawing? Because you reduce his capital account. To reduce the capital account, which is the credit side, you do the opposite, which is the drawing account. And of course, you need to credit your purchases because if you will recall, purchases has a normal debit balance, and to reduce it, because of the withdrawal by the owner, so you need to credit it. On January 11, sold merchandise on cash basis, 4,000. When you recognize a sale on cash basis, what do you receive? Of course, you receive cash. So you debit cash by 4,000. And because you recognize sales on this day, what account will you use? Very good. Sales, because sales has a normal credit balance. So debit cash 4,000, credit sales 4,000. Thank you very much. I hope you got all the answers right.